of solvency or leverage ratio measures the long-term ability of the business to meet interest payments. So, kasapulan nga maamuan ti kinabayag na tapno maalam ti mabayadan nga interest na. Times interest earned determines the extent to which operations cover interest expense. So, dahito yung metket, dahito tayo kinabayag or nung may ipanggap iti mainayon nga bayadan. So, it can be computed by dividing earnings before interest and taxes, EBIT, by the interest expense to show how many times the interest has been earned. So, the formula tayo ket times interest earned equals EBIT over interest expense. So in 2013, times interest earned is equal to 8,540 at inuko ni EBIT tayo plus 1,292.50 at imot ni interest expense. So, over 1,292.50 nga interest expense. So, 8,540 plus 1,292.50. So, divided by 1,292.50 is equal to 7,607 times. So, deti nukwati kabayag urno nga mabayadan. So, 7,607 times. So, in the calculation, interest expense is added back to income before tax because the paid, which is a tax deductible item, has also been earned in addition to the remaining income. The higher the times interest is earned, the profitable the business is, and at the same time, the more capable it is in meeting interest payment. The higher the interest earned, the more the business should use debt to finance its activities. So, the interest expense ket mainayon iti EBIT gapu iti nabayadan nga interest ta isut ti maawagan nga tax deductible item. So, nuna nga iti bilang iti interest mo ket adumet iti mapastrek mo iti business nuna nga iti naurnong nga interest at adupay iti mo usar para iti pautang mo. Next is debt equity ratio. The total asset of business firm are provided by the owners and creditors. The larger amount provided by owners, the less risk is assumed by creditors. So, it explains that ni owner ket isuna iti investor, iti business, nga isuti at adu iti obligasyon na unlike the creditors. no ag-invest iti dakkel investor mas nalaglag anti may ambag ni creditor for the business they do together. The higher the debt equity ratio, the more leverage the business is. The more debt is used to finance investing and operating activities, the higher the risk of insolvency, the higher return on equity. So, nung nga iti debt equity ratio, the more nga kilos iti negosyo. No at adumet ti utang anausar para iti negosyo, nangat nga to iti posibilidad maka-encounter ito problema nga awan pagbayad. If the resulting debt equity ratio is exactly equal to 1, this means that the creditors and owners provided an equal amount of capital. As this ratio increases above 1, the number of risks assumed by the creditors' contribution to the company's total assets is greater than the amount provided by the owners. So, the formula tayo, iti debt equity ratio, total liabilities over total owner's equity or stockholders equity. So, in 2013, the total liabilities tayo ket 24,681.50 over total owner's equity nga 22,967.50. So, 24,681.50 divided by 22,967.50 is equal to 1.07. So, in 2012 month, total liabilities tayo at 19,021 over $18,933.50 nga total owner's equity. So, 19,021 divided by 18,933.50 is equal to 1.004. Despite the fact that the debt equity ratio improved a little in 2012, creditors still have a reason to worry since the company seems to rely heavily on outside financing. So, the debt ratio in 2012, which is 1.004, is actually improved a little, but creditors may still have the reason to worry because 0.6 and higher debt ratio is more difficult for them to borrow money. Additional information ni debt equity ratio ket tapno masukat da iti ugnayan ti kapital nga naiambag digiti agpapautang ken ti naiambag dagiti shareholders. So next is equity ratio. The equity ratio indicates the percentage the total assets provided by the owners or stockholders. This ratio is actually the complement of debt ratio and therefore can be calculated by subtracting the debt ratio from 100% or can be computed using equity ratio formula. So the formula can be equity ratio at total owners or stockholders equity over total assets. So in 2013, the total owners or stockholders equity tayo ket 22,967.50 divided by total assets ket 47,649.00. So 22,967.50 divided by 47,649 equals to 0.48. So it times tayo the 100. So it's equal to 48.20%. So the 2012 equity ratio so the total owners equity the 2012 get 18,933.50 over total assets 37,954.50. So 18,933.50 divided by 37,954.50. Yun. So times 100 is equal to 49.88%. So data the equity ratio tayo iti 2012 ken 2013. Creditors have a reason to worry because they assume a large number of risks since they provided more of the company's total assets than its own stockholders. Meaning, the firm relies heavily on outside financing. So, the more the total assets used, the more risk you encounter. At adu ngamin iti utang kesa ta nagapu iti makinbagi. And additional information, ni equity ratio ket tapno ma-measures tay amount of leverage nga nausar tay company.
Okay, so for my next topic, which is marketability ratio. So before we go to the different ratios under the marketability ratio, let me define first what is marketability. Marketability in some words defines that whether a product is appealing to the buyers. So as for the company, in the marketability ratio, whether a stock whether a stock is appealing to the investors. Like for example, if the stock is low priced and they are gaining or they are earning high profit from it, it is appealing. Also, in the contrary, when the stock price of that certain company is high and many investors are still willing to invest in that certain company, it can only mean that that company is highly valuable by the investors. They can see a high potential in that company, and also that company is earning a high profit. That's why its stock price continues to increase and raise over time. So when we say marketability ratios, these ratios are used to evaluate the stock price or the share price of the company's stocks. So the first topic is the earnings per share ratio. The earnings per share ratio measures the amount of income earned for its share outstanding. So in other words, kung magkano yung kinikita nung isang stock na binili mo sa isang company. Yun lang yun. So for example, meron kang biniling isang stock sa company, may one stock ka sa company. Pero yung stock na yun, for example, one stock is 1 peso, yung par value niya. Yung stock na yun, nag-earn siya ng, for example, 5 pesos per stocks. So, if you have 2 or 3 stocks, that means you have 10 or 15 pesos na na-earn mo na ng dahil dun sa stocks na yun. So, ganun lang siya. One stock, kung magkano yung na-earn niya, dun sa isang stock niya lang. So, kung mas marami kang stocks, like for example, 100 yung stocks mo at 5 pesos yung na-earn ng bawat isang stock na yun, so yung total earnings mo is 500 pesos. Ganun lang siya. So, the formula for the basic earnings per share ratio is net income over weighted average number of ordinary shares outstanding. So, when we say ordinary shares outstanding, this relates to the common shareholders. Kasi, in computing for the net income, you have to deduct na already the preferred shares of the preferred shareholders. Kasi 'di ba? So bakit natin kailangan i-deduct yung preferred shares para makuha natin yung net income? Okay, it's a good question. Kasi yung mga preferred stockholders is priority sila ng company. So hindi sila pwedeng makihati doon sa paghahatian ng mga common shareholders kasi iba sa kanila. So from that income, supposedly the net income, kailangan mo munang i-deduct yung preferred shares ng mga preferred stockholders, and then difference will now be the amount that will be distributed and divided to the common shareholders. So again, the formula for the basic earnings per share ratio is net income divided by weighted average number of ordinary shares outstanding. Let's take a look at the GLAM's financial statement of financial position and the income statement as well. As we can see in the presentation, the net income is 4,697,000. The ordinary shares from the 2012 and 2013 is amounted to 2,401,500 pesos and 2,297,000 divided by 2. So let's compute for that. So that would be 4,698,500 divided by 2, which give us 2,349,250. So we will now divide 4,697,000 by 2,349,250, which will get the answer of 2 pesos. This 2 pesos is now the earnings per share, or in other words, yung 2 pesos na to is ito yung kapalit ng 1 piso na binayad mo. So for every 1 peso na binayad mo doon sa company na yon, yung isang stock na yon, nag-earn siya ng 2 pesos. So that is the earnings per share ratio. More of this will be discussed in our Google Meet in our discussion. So just prepare yourselves, guys. Thank you.
Good day. I will tackle the price-earnings ratio. So based on the given module, let me define first what is price-earnings ratio. So price-earnings ratio indicates how many pesos are required to buy a peso's worth of earnings. And by merely looking at the price per share, no one could not determine whether the price is cheap or not. For instance, a share that sells 90 is not necessarily more expensive than a share that sells 40 pesos. If these prices per share, the resulting price ratio reduces the stocks to a common unit is measures for comparisons with other stocks. So the price earnings ratio is one of the number of measures used to assess the value of a company. PER measures the amount that investors willing to pay for each peso of a firm's earnings. It answers how expensive are the shares of stocks. Halimbawa, bibili ka ng stock ngayon. So alam mo na ba kung ito ay mura o mahal? Ang price earnings ratio ay kilala sa tawag na PE ratio o PE multiple, na ay isa sa mga paraan kung gaano kamahal o kamura ang stock price ng isang company. Kaya bago ka bumili ng isang stock, alamin muna ang PE ratio nito. May dalawang components ang PE ratio. Una ay ang price. So ang price is the stock price of the company, o which means to say, ito ay stock price o kasalukuyang presyo per share ng isang stock. Pangalawa, ang earnings naman. So ang earnings ay makukuha sa latest financial report ng isang company. So let's proceed to the example given in the module on how to get the price-earnings ratio. So price-earnings ratio is equal to market price per share, divide it by the earnings per share. So as of 2013, the market price per share niya is 30 pesos. At ang earnings per share niya is 2 pesos. So, our market price natin is 30, meaning to say, yung stock buying and selling price niya in the stock market or in the market is 30. So, divide natin ang market price per share na 30 at ang earnings per share na 2 pesos. Makukuha natin ang 15 pesos. So, every peso that you earn, you are actually pay 15 pesos. That's how expensive it is to buy that stock. So, the higher your PER, the more expensive the stock is. Low PE ratio could indicate the following stagnant company's growth. that the company is burdened with excessive debt or that the stock could be undervalued and people will hesitant to invest in this type of company. But a company with high PE ratio could be overpriced, meaning mataas ang perceived value niya. People would like to own or buy the stock of that company, or it could have dependable future earnings growth brought on by recent expansion, acquisition, or new product line, and making it a good choice for growth investors. So, ang price earnings is 15 pesos, which means that it costs 15 pesos by 1 pesos of annual earnings.
So let's go to the dividend yield. One of the reasons why investors buy stocks to measure the rate of return in the investor's common stock investment. The dividend yield may be computed. Investor may be compared the dividend yield with the desired rate of return on investment to determine the desirability investing in a company. The formula in getting the dividend yield is dividend per share divided by price per share. For example, the dividend per share is 0.33 and the price per share is 30. So let's divide. So if pag nakuha mo na to, i-convert natin siya sa percent. So times 100. So the dividend yield will be 1.1%.
Last is the dividend payout. Dividend payout is the ratio of dividends per share to earnings per share. It represents the percentage of company's earnings paid out to shareholder in the form of dividends. It also tells us how much income you can expect from the company. The dividend payout ratio is calculated by taking the yearly dividend per share, dividing it by the earnings per share, and the answer will be multiplied by 100%. Let's take this example. In the year 2013, Glam Inc. has a cash dividend per share of 0.33. Dividend per share is calculated by using this formula. Dividend per share is equal to total dividend divided by outstanding shares. So the total dividends is equal to 791 divided by the outstanding share of 2,401.50 to get an answer of 0.329 or 0.33. And it has an earnings per share of 2 pesos. Earnings per share is calculated by using the formula earnings per share is equal to net income divided by weighted average number of ordinary shares outstanding. EPS is equal to 4,697,000 net income divided by weighted average number of ordinary shares, which is 2,401,500 plus 2,297,000 divided by 2 is equal to 1.9 or 2. We plug out the given number. So dividend payout is equal to the common dividend share, which is 0.33 divided by 2 earnings per share times 100%. So 0.33 divided by 2 is equal to 0.165 times 100% is equal to 16.5%. This means that 16.5% of the company's total earnings for the year 2013 was distributed to the stockholders through dividends. Dividend payout ratio is a calculation that investors should know about. It is therefore very important that a company can increase its net profit yearly. So, that's the end of our report. Good day everyone and God bless.